Alright, so today we are continuing with our procedure of group account and consolidation. So if you've not watched the introduction video, you can probably go to the videos, our channel, and then watch the introduction to be abreast with what we are going to do in this particular lesson. So in this lesson, we are probably going to look at IAS 27, that is separate financial statement. So IAS 27, separate financial statement. That is basically what we are going to look at in this lesson. Consolidated financial statement is governed by 6 standards, and one of the standards is IAS 27, separate financial statement. What does this mean? This is mostly what we've been doing all this while. Like you preparing your income statement for an entity. Here you don't consolidate, but you prepare your separate financial statement. But here there is a difference. The difference is that an entity who is now the parent, so a parent because he has acquired, he's having more than one subsidiaries, or he's having a subsidiary, he's having an associate, so we have a subsidiary, he's having a parent, it can be a joint arrangement or joint venture, will be required to consolidate or prepare a consolidated financial statement, except when there are exceptions to which a parent is not required to prepare a consolidated financial statement. But even before an entity is allowed or is required to prepare the group account or the consolidated financial statement, the entity is required to prepare a separate financial statement. That is what it means, accounting for the interest in the other group. So it means that an entity, let's say EPLC, is having a subsidiary, is having an associate, is having a joint control or a joint venture, will be required to prepare a separate financial statement. That means if this entity is not having any of such acquisition in other entity, then it is the normal, financial statement that the entity is required to prepare, accounting for those acquisitions which does not warrant subsidiary, associate, and joint ventures under or in accordance with IFRS. So an entity is required to prepare a separate financial statement, even though that entity is having an interest in a subsidiary, an interest in an associate, or an interest in a joint venture. So the entity accounts for such investment in a subsidiary, an associate, or a joint venture, either at cost. So either at cost, or 2, in accordance with IFRS 9, that is financial instrument, or in accordance with or using the equity method that is described, equity method described under IAS 28, that is investment and associate. And that IAS 28 is also one of the standards that governs the consolidated financial statement. Alright, so we are saying that anytime the entity is supposed to prepare the separate financial statement, is supposed to be governed by accounting for certain investment either at cost, that is or using in accordance with IFRS 9, or using the equity method. Mostly when we are using the cost method, we are going to use IFRS 5, that is a non-current asset held for sale and to discontinued operation. So here the entity will be allowed to account for its investment or in its acquisition at the lower of carried amount and fair value less cost to sell. That is, if you are using the cost, you are accounting for such investment at cost. In accordance with IFRS 9, probably you are going to use the guidance provided in accounting for financial instruments. And again, if you are going to use the equity method, you are going to probably account for that. The standard has not actually prescribed a detailed presentation on how to go about that, but it just requires that an entity will prepare a separate financial statement, even though you are having investment in such or investment that are warrant subsidiary and associate or joint ventures. But there are sometimes the entity will acquire the entity and there may be a reorganization or a restructure of the capital or reorganization of the entity. So here we are saying that you can do that, or the parent entity can do that under certain criteria, and there are 3 in number. So the first one is that the new parent obtain control over the original parent by issuing, or in exchange of what, issuing equity instrument for existing equity instrument in the what, in the existing what's the name, parent. So here a new parent is obtaining control over the original parent. So there is a new parent who is obtaining control over the original parent, and then he is obtaining that control by issuing what, equity instrument, nesting for equity instrument that is existing in the what, original entity. That is 1. 2 is that the assets and liabilities are the same for the new and the original group immediately before and after the reorganization. So the assets and liabilities are the same for the new and then original group immediately before and after the reorganization. That is another criteria that an entity can reorganizes a company or an already existing parent. And the last one is that the owners of the the new group and the original group have the same absolute and relative interest in the net assets of the new group and then the old group immediately before and after the reorganization. So that's the 3 steps or the 3 criteria that might be present when the entity wants to reorganize or perform reorganization of an acquired parent. So therefore, the next thing is disclosure. Disclosure is about the interest that you have in the various entities. If the acquisition is warranting a subsidiary, or the acquisition is warranting an associate, or is warranting joint venture. So that is basically about IAS 27, and it doesn't present any form of difficulties in the process of consolidated financial statement. Probably there will be no question basically on this. It just gives us the guidance on what is being done if you are a parent. Please remember that mostly the questions that can be asked here are mostly theory, probably how they are accounted for, but not a practical set of questions. But remember, they also guide us in the consolidated financial statement process. Thank you.